Noah, thank you so much for joining us today. Take some time. I'm excited to go through and look at these numbers at on this specific property in Vineyard, this 18 Plex. Before we dive into the details, would you mind just sharing a little bit about your background, what you're doing, and what you've been involved in?
You bet. And I wanted to thank you too, Matt, for the opportunity. And a little background on me. I'm with BMC Capital. We've been in business since 1993. I've been in real estate finance for about 15 years personally, and with a focus in multifamily. And so the majority of our business on the multifamily side is done with agency lending, so Fannie Mae and Freddie Mac. And originated over $1 billion in loans, and we're active in Salt Lake City as well as the rest of the United States. So all 50 states, based out of Dallas, Texas. And
nice.
I'm currently in my house here in University Park, Texas, just up the road from our office.
Nice. Well, I'm loving the accent. Us Utahns, we don't have as nice of an accent as you guys down in Texas. So thanks for sharing it.
Hey, can't have it all. You guys have good good scenery there, though, right? Nice place to ski and a good lake. Probably not great for swimming, but
pretty to look at sometimes.
That's right.
Well, let's talk. I just have a couple notes here that I thought we'd kind of go over. I thought it was interesting to have you come on and talk about this because you're a lender that's done properties like this. You've lent on properties like this, and I think it's really important to work with a lender. And you could probably speak more to this, but with a lender that's already done a property like this, you're not going to. It's less likely to run into issues in underwriting. Getting everybody excited, and then to come to find out there's something wrong with the HOA, or the terms weren't quite as what it expected. Have you found in the other properties that you've done financing for, in the Vine, right? There was, anyways, has there been some scenarios that come to mind that help?
Yeah, I mean, it's absolutely a huge advantage to have already done the exact same project multiple times. The Vine's a unique situation where you have 26 buildings that are all around a specific HOA and the clubhouse. And so that's 26 opportunities to do the exact same loan. We've done 6 so far and have another 6 in the pipeline. But what is extremely helpful is we've been through the scenario with Fannie Mae, with other banks, but we've wrapped our arms around all the potential issues. We've overcome them, and it's just simply a matter of the specific buildings' occupancy and performance, and the sponsorships, experience, and net worth. And it's kind of plug and play from there. We've done it already. It's kind of an assembly line now. We just not recreating the wheel. So it does make for a much smoother transaction and your experience for everybody.
Well, I'm excited to get into details with you because I think there's some specific things about the type of financing that you offer that investors or the potential buyers for this property would be interested in. Before we get started, if people have more questions about the financing end, what's the best way for them to contact you?
You can reach me directly at on my cell or office phone that both ring to the same number at 214-580-3142. And via email is always easy at nlaredo, that's N as in Noah, Laredo, like the town in Texas, at bmccapital.com. It's Bravo, Mexico, Charlie, Capital, so 2 C's.com.
Noah's your man. If you got questions about this, contact Noah. He's done it before, and he's going to be able to get you lined up. So let's dive in. We have this 18 Plex. It's in Vineyard. As of today, the asking price is $3.7 million. It's that newer property, 2019. Really nice construction, and it's fully leased. I actually went over there this morning, talked to the property manager, Candy. She's really sharp at what she does. She runs a tight ship, that's for sure. what's unique about the financing terms on this property as far as what you can offer? Let's talk about minimum down, interest rate, non-recourse, and the ability to transfer ownership. Some of these things aren't always the same, especially in commercial lending. Talk to us a little bit about that.
Yeah, so this, we were the first group to get this project or any other project in Vineyard, Utah, approved for agency financing. Agency financing meaning Fannie Mae or Freddie Mac. They are the largest lenders for multifamily real estate. Anything $1 million and up. And so it provides a unique opportunity through the agency debt platform to really highly leverage these with long-term fixed rates and long-term amortization. We're seeing 30-year AM is the standard. Interest only is available. You can at least 1 year of interest only up to a full term of interest only, depending on your leverage point. So
if someone hasn't invested in this kind of real estate, why would someone want to go interest only?
Well, you would like interest only for the cash flow, right? And it's obviously going to improve your IRR. So if you have investors as well that are looking at yield, those numbers are improved with an interest only loan. So you're not paying down principal, but arguably with 30-year amortization, we're not going to have a lot of principal reduction over the first 10 years, regardless. So, especially when you're at a good leverage point, obviously we don't want to do full term IO at a 80% leverage, but when you're at a good equity position, we can accommodate those longer term interest only options, which really just allow you to cash flow. And a project like this is stabilized currently, but sometimes it's nice to have interest only while you're going into maybe a lease up phase or maybe a value add play where you'd need that extra cash flow
okay.
Most investors appreciate the interest only for the extra cash flow, the extra yield, the increased IRR.
Okay, cool. So that helps. There's some flexibility there. What about like down payment and interest rate? What would we be looking at for this?
Right. So the requirements or the loan to value that we're seeing in Vineyard, Utah, through the agencies is going to be 80% max, and that's going to be debt coverage, supported. So you have to have a DSCR of 1.25. So take your effective gross income minus your operating expenses, then you hit your NOI. And so your NOI has to cover your debt service 125%.
Yeah.
So as we're there, we can lend up to 80. And so that's really the maximum you'll get anywhere. But 80% LTV. So as little as 20% down. In most cases, you can expect 25% down as a safe bet. That's usually what.
Okay. So we're looking at 920 on 25% of 3.7 mil is 925,000 for the down payment, roughly.
Correct.
Okay. Awesome. And what would an interest rate? Oh,
yeah,
sorry.
Interest rates, fluctuate like everything else, but this particular project has a not all bills paid, but a majority of the bills paid. The tenants are only responsible for gas and electric. So the rent payment covers quite a bit of their monthly expenses. So this is considered an affordable project, not affordable in the sense of low income housing or Section 8, but what it does is trigger a improved pricing from Fannie Mae and Freddie Mac. And so for that reason, interest rates on this deal can be very attractive. And we just closed one mid-month. This was a cash out refinance for a gentleman who had purchased the property and been through it for the entire lease up, bought it as brand new construction, and then now is able to cash out at 75% loan to value. And we were able to lock in a 3.66 interest rate fixed for 12 years on that.
Wow.
Of course, during the COVID-19 pandemic,
Yeah.
was a little pressure there we would have had a year of interest only normally, but due to the current conditions, that on cash out wasn't available. But it is available on purchase transactions. So confident we can achieve very similar terms on a purchase. That was a Fannie Mae execution, and as mentioned, at 12 years fixed, 75%, 3.66 interest rate. We're seeing the interest rates move a little differently than they have in the past because of the market uncertainty. So, normally you could base them on the 10-year Treasury and then a spread. They've moved a little bit differently in the past 8 weeks, but we expect them to normalize here. They're doing that now. Today, Freddie Mac, for the second time in April, cut rates by 25 basis points on their small balance products. So things are starting to normalize there as well.
Okay. So would you say it would be, as far as right now goes, an interest rate for a 30-year loan on this would be somewhere ballpark of 4 or under?
It would be under 4%. I would say you're going to 25% or higher loan through the agencies today, and that's non-recourse.
Yeah, let's talk about that. What does non-recourse mean?
Non-recourse is a great concept. A lot of investors in this space call it, 10 million and under, aren't that sensitive to non-recourse. But what it means is you essentially aren't on the hook. You're guaranteeing the loan, but the property is really what's, the property is the collateral, not your assets, for example. And
personal assets.
It's almost a requirement for institutional investors, and that's why it shows up on these agency loans. But what's really unique about it is, instead of a full recourse deal where a bank may be willing to go to maybe 2 times your net worth, the agencies, although they'll only allow a loan up to your net worth. So let's say you have a $3 million net worth, you can do a loan equal to or less than your net worth. You can't do one $4 million with the agencies, non-recourse, but you can do 15 or 20 $3 million, which you'll never be able to do in the banking world.
Yeah.
So recourse, tap out at about 3 times your net worth with a good, relationship.
Yeah.
This is a way for people to scale up. As long as you can bring the equity to the table and sign the guarantee with a sponsor who has a net worth equal to or greater than the loan amount, they'll keep going. So that's the nice part about it. It's really an opportunity to grow your portfolio and benefit from economies of scale. So.
Yeah, absolutely. That's definitely unique in the lending world. Especially when you go residential, right? Then you're capped, right, at 10 loans total. So, but when we jump into the commercial space, to make this non-recourse and the ability to get as many loans as you want up to your net worth gives you a lot of leverage. So, love that.
Yeah.
So transfer ownership, can we talk a little bit more about that as well? Why would an investor want to, and when would they want to transfer their ownership with this particular loan, giving them the capability to do so?
You bet. So these loans are fixed for, like I said, anywhere from, they have a 5, a 7, a 10, and a 12-year option. So you can expect to have a long-term fixed rate on this. That said, you should, plan accordingly based on your holding strategy. And if you decided to sell for whatever reason or needed to sell before the term expires, another buyer could assume your loan. So these are assumable loans, meaning, let's say 5 years from now, rates aren't 3.6, but they're 5.5%.
Well, you're really attractive.
3.6 that someone could assume, and they'd be able to assume that loan and do an additional supplemental or second loan behind that at closing to, bridge the delta from what you owe to what you're selling it for and get to about 75%, probably no more than that. But at any rate, it offers a unique opportunity to transfer the property through a loan assumption without triggering any prepayment penalties and while offering the same interest rate, and terms that you have. So we're seeing a lot of deals hit the market now with assumable debt because, loans were just done in the past 3 to 5 years, and still have attractive terms, still have interest only. And so someone can come in and assume that. And it just makes the process a little easier, makes the asset a little more liquid than if you had to sell it, with new debt and potentially pay off a prepayment.
Yeah, awesome. Okay. Well, this has been really good. I got one other question for you, and we'll just kind of wrap this up. Let's talk about some possible scenarios. So obviously, one person could come in here, whether they have $900, and I think the number is $25,000. They put as down payment. Their net worth is equal or greater to the purchase price amount. They're good. Or what about a group of people? What if this was more of a syndication? What are the possibilities there?
So we see a ton of syndication on the agency side, and it's set up for that. Each deal has to be held in a special purpose entity or a single asset entity, meaning they don't want to have all of your real estate loans and properties tied up under one LLC like you might do on a single family portfolio. They want to see each property in its own specific LLC. And so then what happens is whoever is involved in that LLC becomes a guarantor if they have 20% ownership. And so they don't individually have to meet those requirements. They globally meet the requirements. So let's say you had 4 individuals come in at 20%, and then you had maybe another, I don't know, you call it 50 individuals come in with the remaining 20% of equity. The 50 individuals that own less than 20% each are not underwritten. They're not considered, borrowers. They're called limited partners. So they're LP investors. And those are the people you're syndicating to, getting those, $100,000 checks from. And then the 3 or 4 other gentlemen combined would meet the requirements for the net worth liquidity experience. And so that's really how it works. But we see, we'll see partnerships, we'll see TIC structures, depending on your tax advice. You may set up a TIC to facilitate several 1031s. It's a little more costly on the legal side to do that. Other groups are facilitating 1031s without the creation of a TIC. They'll just, each 1031 is a 10% owner of the single asset entity, and in their mind, that's in the spirit of the IRS guideline, and they're okay with that. But depending on your counsel and your accountant, you'll want to set that up appropriately. But this particular execution allows for all of that. So whether it's one person or 100 people, we do the deals. It's just a matter of who becomes the general partner, the key principal versus the limited partners. And, but it's across the board, easy to execute, no matter which way you slice it. And just add a few costs if you're trying to do a real syndication or a TIC structure. Your legal bill will be higher, just inherently.
Cool. Well, there's a lot of options here on this property. I think what's really appealing about this property is that it's so new and it's in such a great location. In fact, you were just mentioning how you had an owner that was doing a cash out refinance, largely, I'm sure, to the growth in that area that's seen being right next to UVU college campus with a lot of students and growth in Vineyard City. So really cool. Anybody with questions, we'll direct them your way so you can talk more specifically about what they're looking to accomplish. And we'll see if we can't put this deal together.
Yeah, would love to continue the conversation with anybody who's interested. And of course, know that there's other execution available besides agency. That's just our preferred execution and probably the best, in my opinion, for this particular building. But we can facilitate, life company, credit union, bank, bridge, which, apply to a certain degree to this project. In my opinion, and I think Matt's as well, the agency execution for this deal is really the best way to go for a long-term hold.
Yeah. Yeah. Okay. Well, with that said, we'll sign off. Thank you again, Noah, for your time, and we'll get to work.
Yeah, I appreciate the opportunity, and look forward to continuing the chat, and we'll take it from there.
Okay. Sounds good. See you later.